Today, over the precipice. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 11th of May 2019. Our digest of the latest finance and property news with a distinctively Australian flavour. And the big weeks just keep coming, with the RBA's complete change of stance on monetary policy, the trade wars hotting up between the USA and China, and of course risking collateral damage more widely. Property prices are falling as the local market weakens, and household consumer confidence is drifting lower. Yet, during the election campaign, both sides remain tight-lipped on the fact that their financial projections are in fact built on sand. Before we start, a quick reminder that you can support our work with a one-off payment via PayPal, here's the link, or via a subscription via Patreon, where you can pay via one of the tiers from as little as $3 a month, or pay more and get additional access to exclusive content, as for example, this week, the interview I did with Channel 9 on the property market. The links are also in the comments below. So let's start with the RBA statement on monetary policy, because this was a significant change in attitude from the bank after they left the cash rate on hold last Tuesday. And I looked in detail at their projections in our post Duck and Cover. And by the way, in New Zealand, the Reserve Bank there cut the cash rate to 1.5%. They signalled risks from China and Australia, and that lower mortgage rates may help household finances and housing. But the RBA's substantial reductions in their growth and inflation forecast is a major change of tone. GDP growth is now forecast at 2.6% for 2019 and 2.7% for 2020. That compares with 3% and 2.7% in the February statement on monetary policy. The main explanations for the growth reductions in 2019 are consumption, 2% compared with 2.5% previously, and dwelling investments, down 6.7% compared with 4.5% previously. The underlying inflation forecasts have been reduced from 2% for 2019, which was in the February statement of monetary policy, to 1.75% in May. And the 2020 forecast reduced from 2.25% to 2%. And the forecast for the unemployment rate has been slightly increased, with the 5% unemployment rate still expected to hold through 2019, but the fall that was predicted to 4.75% has been pushed back from December 2020 to June 2021. There are 2 points I want to emphasise. First, the statement in monetary policy emphasises that the Reserve Bank thinks it's highly likely that it will need to follow market pricing with 2 rate cuts sooner rather than later. This means the current budgets, which both sides of politics are using for their campaigns, are now based on false and decaying assumptions. Iron ore receipts apart, a surplus may be later and smaller on the revised scenarios, with more bad news to come. I fear honesty in the campaign is as bad as ever. The second point to make is that the RBA is looking past low inflation to the labour market, despite their upward revision in unemployment. The Reserve Bank's April minutes noted a scenario to cut would likely be appropriate where inflation did not move any higher and unemployment trended up. And in May, they still shifted further in the dovish direction, saying further improvement in the labour market was likely to be needed for inflation to be consistent with the targets. So this signalled that a rise in unemployment would cause a rate cut. But as UBS put it this week, the ABS data series behind the employment numbers is highly suspect. The labour force survey uses a tiny sample of just 26,000 dwellings, or 0.32% of those aged 15 and over. So month-on-month moves are incredibly uncertain. Indeed, the 95% confidence interval, bounded by 2 standard deviations for unemployment, is a massive 0.4%, or 0.2% either way. And for employment, it's a huge 122,000, or 61,000 each way. Plus, the ABS series is an outlier compared with other sources. So UBS says sample noise alone could lift the unemployment rate to 5.2% and see the RBA cut. And this leads to question why so much importance is now being placed on a single data point. And it's also worth highlighting, as noted in the Australian this week, that analysis by JP Morgan shows that nearly 140,000 jobs were lost in Australia's manufacturing, construction and retail sectors in the first 3 months of 2019. Tom Kennedy of JP Morgan notes that so-called bellwether sectors are the most closely linked to the economic cycle. He says rising job losses in these sectors will put upward pressure on the unemployment rate. Because of these moves, they expect the unemployment rate is going to rise to 5.5% by the end of the year. And we see the same in our surveys and note that it's publicly funded or heavily subsidised industries, such as the public service or the healthcare sector, that were doing most of the heavy lifting in terms of job growth. Plus, of course, the bedpan economy. And two wider points to make. Cuts in the cash rate will hurt savers further. They continue to get the damp end of the stick, and many are forced now to dip into capital. And the limited cuts in rates available at the current low 1.5% means mortgage holders will not receive much relief, so cuts will not turn the housing market around. And we expect more unnatural acts, such as quantitative easing via mortgage-backed security purchases, or more incentives to bribe more feckless buyers into the market. This remains a policy disaster. And as Brett Gillespie at Ellison Capital noted this week, the RBA not cutting rates in the middle of an election is completely predictable. Think about it. If you were the governor and you have not moved the cash rate for almost 3 years, a move is going to create a lot of comment. It is not clear which party would spin it best, but it is certainly clear that it will be front page for the last week of the campaign and could be blamed for influencing the election result one way or the other. Waiting 1 month means nothing for the economy, but it significantly reduces the risk of the RBA creating enemies. Exactly. Oh, and Phil Lowe is forecasting that he will be the first governor to miss the RBA's target band on average over his term since Bernie Fraser adopted inflation targeting in the early 1990s. Not a good record. So to the housing market. Here, price falls are accelerating again, according to the CoreLogic indices. So the CoreLogic index to the 9th of May showed that Sydney fell 0.32% over the last week, down 2.54% over the quarter, down 11% annually, and down 14.8% from peak. Melbourne fell 0.18% over the last week, fell 2.07% over the quarter, and has fallen 10.1% annually and 11% from the last peak. Brisbane fell 0.12% over the week, down 1.9% over the quarter, down 2.2% annually, and down 1.8% from the last peak. Adelaide rose 0.01% last week, but fell 0.31% over the quarter, rose 0.3% over the last year, and fell 0.6% from the last peak. Perth fell 0.07% over the last week, fell 1.9% over the quarter, fell 8.3% annually, and fell 18.5% from the last peak. And the major five fell 0.2% over the last week, fell 2.07% quarterly, fell 8.9% annually, and 10.5% from the last peak. So another way of looking at this data is just to look at the day-by-day trends over the last year. And you can see there that Sydney has been quite consistent in its falls, but recently the falls have been a little stronger. And this, I think, counters the view of some that things were actually turning the other way. Melbourne is somewhat similar and continues to fall, as does Brisbane, though to a lesser extent. Adelaide is looking a little more stable, but is still down from its recent highs. And, of course, Perth continues to slide south, as does the 5 cities. And the rate of decline continues to increase, so there is no evidence in this data to suggest that in any way at all home prices are over the worst. And auction clearance rates, while they topped 50% last week at 52.5% to be exact, are still on such low volumes as to be meaningless, with auction volumes down 32% in Sydney and 41% in Melbourne versus the same weekend last year. But there was a chart which Steve Keen, he of the 40% property price fall prediction more than a decade ago. His point is that the falls we are seeing is mirroring the US through the GFC, but prices still have a long way to fall. And he discussed this with Peter Switzer on a YouTube post, which I recommend. Here are a couple of quick grabs. The link to the full show is in the comments below.
About the argument that a lot of Australian households have buffers. It's a very big number that have buffers within their debt. So the debt numbers you're looking at could well be exaggerated. What's your view on that? I'm sure you've heard it. I'm sure you've tested it out. What's your view?
Oh, they do have buffers. This is actual data about how much they owe. So, like, it's true they've got some of them paid more than they need to pay. They're in advance of their principal payments on their loans. But don't forget, we've put a real time bomb in here, and this is, where you've got to take your hats off to the regulators in this particular economy. They let so-called interest-only loans become 40% of total loans, total new loans. Now, interest-only loans, let's get rid of the jargon, are loans where you don't start paying the principal back for 5 years. So you have 5 years with just interest payments, and then 20 more years with interest payments plus higher principal repayments because you haven't paid anything off the principal.
Yeah, a lot of those people flip their homes, don't they? That's what they think they're going to do.
The trouble is they can't flip if they haven't got a buyer and the house prices are falling. So they're about to see a 40% increase in their servicing costs, and there's masses of them. So that's going to just blow that particular thing out of the water.
So I'm not going to bet you so you have to walk to Kosciuszko. That's something that nasty Rory Robertson did to you. But what I do who of course is a friend of mine as well. But what
I like Rory. We fight, but I like him too.
Okay, so I want you to outline what you think is going to happen over the next, like, how long is it going to be before this Armageddon of a 40% price fall going to happen?
I'd say something about 3 years.
Right, so 3 years?
Yeah, and then it'll turn around. And the government, of course, will do everything they can to stop it. So we're going to get stamp duty exemptions. We're going to get first home vendors grants coming back in. They're going to probably halve, particularly if the Morrison managers scrape over the line. Reduce capital gains tax to zero, etc., everything to stop it happening. As I said, if they succeed in doing that, and that they certainly can slow it down, they may turn it around, but I don't think they will, then they're just going to delay it further because the debt levels will rise even further, and we'll have in future, we're going to have more debt to get out of yet again. The Achilles heel to that argument is it always relies on being able to carry more debt. Now, we're already at global record levels, and we think we're going to go higher. I think we just have to realise just how extreme we are. And again, I'm going to do another share screen on you. So the blue line is America.
Yeah.
Notice it reached this is the household debt, about 100% of GDP, and then it fell. And it's down now to about 75. The red line is Australia. We started off well below them. We're above them at the GFC, which is why I expected us to have a crisis back then. I couldn't see us increasing debt levels. And we've now gone from there up to 120%.
Keen's point that the RBA does not think credit is a problem is critical to understand, as they, of course, have created the high debt. And Switzer's point that there is no strong argument to counter Keen's projections was also significant. It's worth also noting that Sky is closing the Your Money channel, perhaps because in the current environment there is just not sufficient advertising to fund the channel, which is the one where Uppercut Adams had his debate with Christopher Joy. And talking of businesses folding, Purple Bricks, the hybrid real estate agency, has announced its exit from Australia after 2.5 years of trading, citing challenging market conditions and execution errors. Its offer of low-fee property sales had shaken the market, and conceptually it's still a great idea, but in the current low-volume environment it was not sustainable. The real estate sector was celebrating the end of a potential disruptive player. And it's worth noting that McGrath, the ASX-listed real estate group, continues to languish on lower volumes at 22.5 cents, down 43.59% over the year. And we expect more real estate job losses in the coming months as the industry right-sizes to the new world. The problems with flammable cladding rumble on, with Strata Communities Australia and the Greens calling for the federal government to pay for the upfront costs of removing flammable cladding from apartment buildings. As the AFR reported, Greens MP Adam Bant says now is the time to act and get rid of flammable cladding, given the potential dangers. He says the government should fix the problem now and then recoup the costs from those responsible later. Now recall that Jeff Hamner, adjunct lecturer in architecture at the UNSW, has recently warned that legal costs alone, pertaining to the estimated 1,000 buildings with flammable cladding, could top $1 billion. He also warned that taxpayers could be forced to bear some of the costs, given government deregulation allowed flammable cladding caused proliferation of the materials. This uncertainty about the quality of new construction is putting further downward pressure on unit prices in many areas, and some apartment owners are looking at having to pay as much as $60,000 to have cladding removed from their unit. This is just one more element in the property sector debacle. Of course, in the lead up to the election, some are claiming that Labor's scheme to grandfather existing negative geared property investments but prohibit gearing on existing property purchased in the future will kill the market. This is extreme scaremongering in my view. There is some logic which says that when an existing property investor goes to sell, the asking price will be lower as the next purchaser cannot negatively gear the transaction, but my modelling suggests the real impact is very low given the lack of investment purchases, and that there will be a slight swing up in demand for new property where negative gearing is still available. The truth is, the impact will be lost in the roundings, and in the current cycle, capital gains just will not be there. So it's a good time to deal with an issue which has distorted the property market for years. We published our latest mortgage stress and household financial confidence indices this week, which showed more households in financial difficulty, more than 1 million, and the confidence levels are as low as we've seen them. You can watch our shows, Household Financial Confidence Decays Again, where we walk through the decline in household confidence and discuss the significant collapse in household wealth. The mortgage stress data is contained in our post The Big Numbers Are In, which again goes into the analysis of stress in some detail, plus the latest retail turnover falls and trade gap rises. But in summary, Australia has more than 1,050,000 households now in mortgage stress, up 10,000 from last month. This equates to more than 31.7% of unoccupied borrowing households. And John Adams and I discussed the implications of the downtrends to real households following his visit to Melbourne, to the outlying suburb of Donnybrook, where there are massive numbers of new properties being built. You can see our In the Interest of the People post. The social impacts of the current downturn have yet to be fully realised, but the signs are there for those who want to see them. So to the markets. The ASX 100 was up 0.29% on Friday to end at 5,206. The ASX Financial 200 was up 1.5% to end at 6,071, and the Local Volatility Index was up 0.91% on Friday to end at 1395. Westpac Corporation was up 0.59% to 2722. Westpac reported a 24% fall in profits in the half and rising mortgage arrears. You can see our show Westpac dropped profit by 24%, and they're still in court with ASIC over poor mortgage lending practices centred on the use of household expenditure measures, or HEM, and whether they are sufficient to be classed as a responsible lending approach. Two interesting observations on this. First, in part of that Steve Keen video, he cites NAB's HEM and shows how low the spending assumptions were.
The Reserve Bank doesn't understand that credit is really important. The level of credit is really important.
The level and rate of change of credit and the level of debt. They don't understand that at all. It's not because they're uniquely stupid. It's because they're uniquely strict followers of neoclassical economics, which teaches them the same thing at university.
Well, as I always say to you, Steve, when I have a bit of a debate with you, I hope you're wrong.
I know, mate, and I'm going to finish with one more little screen I'm showing. Can you see that screen at the moment?
Yes, I can.
Okay, that is the household expenditure model for the National Australia Bank. This is one of the documents exposed by the Royal Commission. Things I've highlighted in blue over there are the one I want to talk about. HEM, can you see those numbers in the
Yes.
HEM says that a couple earning 400,000 or more per year gross, which is, of course, we both know an extremely high family income, they are spending $3,700 a month. And therefore they have about 16,000, when you look at their net income, 16,000 they can use to service a home loan. Now, if they have a kid, their expenditures are going per month, expenses are going to go from 3,700 to 3,924, meaning that on the HEM table, the cost of raising a child is roughly $7 a day. Okay, housing, you know that's a joke. You know that's absolute fraud. That is fraud. It's about 20 times that much. So they first of all are saying you save 80% of your income, and secondly they're saying a kid will only cost you $7 a day. And on that basis, they tell you how much you can borrow. That's how fraudulent the lending got to be in the Australian economy after the GFC.
And it's fair to assume that Westpac were operating in a similar fashion. And second, Maurice Blackburn Lawyers has now opened a webpage targeting Westpac mortgage borrowers to sign up for a class action centred on responsible or irresponsible lending. This could get nasty. And you can watch my show from last year when I discussed this with Roger Brown, one of the prime movers behind the class action. See, what have the beasts in the mortgage industry to fear? The Aussie US dollar was up 0.19% to end at 70.01 cents, but has been below 70 for some of this last week and is at the bottom of its range. The spot gold Aussie dollar cross was down 0.01% to end at 1,837. And the Aussie Bitcoin cross was up 2.4% to end at 7,097. And so to the US markets, where it's also been a turbulent week. In economic news, the Labour Department said on Friday its consumer price index rose 0.3% last month, after rising 0.4% the previous month. This supports the Federal Reserve's case to stick with its current pause on monetary policy. And recent developments in the China trade relations with the US, including an increase in US tariffs on $200 billion worth of Chinese goods that went into effect on Friday, have led investors to brace for a potential escalation of the trade dispute between the world's two biggest economies. That in turn has stoked fears of a global economic slowdown, prompting a flight to low-risk assets such as government bonds. But the markets rebounded from early losses on Friday to snap a 4-day losing streak after the President and Secretary Stephen Mnuchin said trade talks between the US and China were constructive. The benchmark S&P 500 index had dropped as much as 1.6%, but rebounded from its session lows after Mnuchin spoke positively on the 2-day of trade negotiations between China and the US. The index pulled back from the session's highs, however, after Mnuchin said no further trade talks were planned. The S&P and Nasdaq logged their biggest weekly percentage losses of the year. Yet, Friday's comments from the White House kept investors hopeful of an eventual trade agreement. Whilst in the short term it's true probably that China needs a trade deal more than the US, in the long term the US needs it as much or more than China, so there is a bit of a balance. The Dow Jones Industrial Average was up 0.44% to end at 25,942. The S&P 500 was up 0.37% to end at 2,881. The S&P 500 Financials was down 0.24% to end at 453. The Nasdaq was up 0.08% to end at 7,916. For the week, the Dow fell 2.12%. The S&P 500 declined 2.17% and the Nasdaq shed 3.03%. Intel Corporation was down 0.9% to end at 46.20. The United States 10-year bond was up 0.71% to end at 2.47, and the 3-month was down 0.19% to end at 2.42. The US dollar index was down 0.05% to end at 97.32. The FTSE 100 was down 0.06% to end at 7,203, and the FTSE Financial Services Index was up 0.21% to end at 690. The pound US dollar was down 0.08% to end at 1.30. And Deutsche Bank was up 2.1% to end at 6.97. Of course, Deutsche Bank has stopped the negotiations with regard to potential merger, and so are now trying to restructure themselves. And the Chinese yuan US dollar was flat at 0.1465, but has moved down in recent days. And gold futures was up 0.12% to end at 1,286. Silver futures was up 0.03% to 1477. And copper futures was up 0.27% to end at 277. WTI oil futures were up 0.05% to end at 61.73. And the Bitcoin was up 3.28% on Friday to end at 6,463. Bitcoin is quietly having a major upswing among a tenuous time for risk assets. As stocks appear poised to have their worst week in 2019, the largest cryptocurrency is surging on speculation. Increased tariffs will see smugglers go to the cryptos to avoid transparency on future purchases. The majority of the recent rally with Bitcoin coincides with recent escalations in trade talks between China and the US, and some crypto blogs keep highlighting comments from US Representative Brad Sherman, who has been a constant critic of cryptocurrencies. His comments at the House Financial Services Committee to outlaw cryptocurrency purchases by Americans is nothing new. And after clearing multiple resistance levels, Bitcoin could see resistance from the 6,700 region. Bitcoin has rallied 7 of the last 8 trading days, but in its heyday has been no stranger to overextended rallies. To the downside, 6,000 becomes a key support mark. And most risk assets are selling off on fears of a negative outcome from these US-China trade talks. But Bitcoin is quietly defying that trend. The world's oldest crypto asset has rallied nearly 100% from its mid-December lows to regain that 6K handle for the first time since November. More to the point, price is testing a critical zone of previous support turn resistance in the range of 5,800 to 6,100. But as I keep saying, Bitcoin is a completely speculative asset. So standing back, the markets are jittery, trade is back in the news, and there is more weakness around, suggesting anemic growth ahead. Locally, the stage is now set for rate cuts and QE, and the kitchen sink will be thrown at the economy to try and resist a formal recession. But this does not bode well for house prices, wages, or employment. The bright spot is the iron ore price. But if this fades, the local economy will tank further. Adopt the brace position once again. Before I go, our next live stream is scheduled for the 21st of May at 8 p.m. Sydney time. This time we will discuss how to protect and survive in the current environment, as well as updating our scenarios and taking questions. Here is a link you can bookmark for the event, and I hope to see you there. And you can also send questions in advance via the DFA blog. The link is in the comments below. And by the way, thanks to all of those who have subscribed, we've now passed 18,000 and hope to make 20,000 by the end of June. So if you found this post useful, please like it, share it, and add a comment or question. I do read them all still. And if you have yet to subscribe, please do so, or ring the bell to get specific alerts as we post most days. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.